The Federal Reserve has significantly lowered interest rates by 50 basis points. However, U.S. Treasury yields have risen, leading to a decline in the Treasury ETF TLT. The Fed's reduction of the federal funds rate primarily impacts short-term rates rather than long-term Treasury yields. TLT is an ETF that tracks U.S. Treasuries with maturities of 20 years or more, and the yields on these long-term bonds have risen, resulting in a drop in TLT. Firstly, while the Fed has excited the market with a notable 50 basis point cut, it simultaneously released a more hawkish dot plot, indicating that the extent of rate cuts for the remainder of the year will be smaller. Specifically, prior market expectations indicated that the Fed would cut rates by 125 basis points by the end of 2024. In contrast, the Fed's dot plot suggests a lesser reduction of only 100 basis points. Thus, expectations for Fed rate cuts have diminished in the long term, reflecting a blend of hawkish and dovish sentiments. Secondly, the Fed's rate cut is a 100% positive signal for the U.S. economy. Lower interest rates can stimulate the U.S. real estate market and enhance stock market valuations. In the context of a clearer long-term economic outlook, rising long-term Treasury yields will also contribute to the decline of TLT. Specifically, short-term Treasury yields are primarily influenced by Fed decisions, while long-term Treasury yields primarily reflect a country's long-term economic development prospects. A good example is the Fed's maintenance of a zero-interest rate policy and quantitative easing starting in 2020. The yield on 6-month Treasury bonds remained low from 2020 to 2021, reflecting the Fed's low-rate policy. Conversely, if we observe the yield on 10-year Treasuries, it bottomed out and began to rise in August 2020, indicating that despite the Fed's zero interest rates, the U.S. economic recovery has driven long-term Treasury yields upward, causing TLT to peak simultaneously. Currently, in the U.S. stock market, Treasury yields continue to rise slightly while stocks are soaring, resembling a trade on a soft landing for the U.S. economy. Conversely, if Treasury yields decline and TLT rises while stocks fall, it signals a trade-on U.S. economic recession. In summary, investors need to clarify the distinction between long-term and short-term Treasury yields, as well as the investment logic behind TLT. In other words, TLT is suitable if you are convinced that the U.S. economy will experience a recession or even a depression.